Most Canadians think RSPs are just for retirement, but if you're a high income earner, they're actually a legal way to slash your tax bill by tens of thousands of dollars this year. In this video, you'll learn 3 things to help you keep more of your money out of the CRA's hands. First, how RRSP deductions work and what lowering your taxable income really means. Second, how much tax you can save with a real example using Ontario's top tax rate. Third, the best time to claim your deduction for maximum benefit. And stick around to the end for the one mistake that can cost you thousands in CRA penalties and how to avoid it. It's the last week of February. A high-income client calls me in a panic. They've just realized the RSP deadline is days away. They're earning well over 250 grand a year, but they haven't made their contribution yet. We run the numbers and discover that a single $30,000 contribution would cut their tax bill by over $16,000. Instantly. The problem? If they miss the deadline, that opportunity disappears and the 16 grand is gone forever into the CRA's pocket. That's why understanding RSP tax deductions isn't just about retirement. It's about making sure you never leave that kind of money on the table. So how do RSP deductions work? An RSP is not the investment itself. It's a special account that gives you an immediate tax deduction when you put money in. Your contribution reduces your taxable income dollar for dollar. For example, if you earn 300 grand in Ontario in 2025, you're in the top marginal tax bracket, 53.53%. Every $1 you contribute saves you about 54 cents in tax that year. But what's the real math for high earners? At 300 grand, a $30,000 RSP contribution saves you about $16,059 in taxes immediately. For a couple each earning 300 grand and contributing $30,000, that's $32,118 in combined savings this year. Why it matters. High earners get the biggest bang for every RSP dollar because their marginal tax rate is so high. That tax refund can then be used to contribute to a TFSA, further accelerating retirement savings and tax-free investment, or to top up your mortgage, leaving you debt-free faster. And timing is everything. When it comes to RSP contributions, timing really matters. If you're in a high income year, your deduction is worth the most because your marginal tax rate is higher. You also have the option to make a contribution now, but carry the deduction forward to an even higher income year, like after a big bonus or selling your business. And remember the deadline. Contributions made in the first 60 days of the year can be applied to the previous year's taxes. That's the rule my February deadline client almost missed, and it would have cost them $16,000 in lost savings. There are 3 ways to time your contributions: early in the year, steadily throughout the year, or in the first 60 days of the following year. No matter which one you choose, the earlier the contribution, the more time your investments have to grow tax deferred. So time really is money. So how do you avoid common mistakes? A few traps can undo the benefits of RSP tax deductions. First, remember, RSPs aren't tax-free. They're a tax deferral. You'll pay tax when you withdraw, ideally at a lower rate. Second, don't overcontribute. Go past your limit by more than the $2,000 buffer and the CRA charges 1% per month on the excess. Third, avoid contributing in low-income years or carry forward the contribution to a high-income year. You'll waste valuable deduction power. Fourth, don't spend your tax refund. Instead, put it into a TFSA or use it to pay down debt so it works for you. And finally, never contribute without considering your cash flow. If you need to pull money out early because of an emergency, you lose that RSP room forever. Now that you know exactly how RSP deductions work and how to maximize them, the next step is making sure you don't go over the limit. If you contribute too much, the CRA charges a 1% per month penalty on the excess. Even worse, many people don't realize that fixing an overcontribution isn't as simple as pulling the money back out. You need to calculate your contribution room properly to avoid the problem in the first place. In the next video, I'll walk you through how to figure out your RSP contribution limit, how carry forward room works, and what to do if you go over. That way you can stay compliant, avoid penalties, and keep every dollar working for you instead of paying it back to the government.